In this video, you're going to learn an option strategy that will continually make you more money in your trading portfolio. In this video, I'm going to show you option strategies that have been proven over time to increase profits and reduce risk. How to place an option trade to take advantage of the smartest strategy, showing you an example on the option trading platform. And at the end, we will provide you with a bonus, a simple formula for winning in the stock market using options. So be sure and watch to the end. Also be sure and download the free options workshop in the link below. It talks about the two main benefits of trading options over buying stocks. Disclaimer, I'm not a financial planner and I'm not recommending trades. Please do your own research, and if you're new or learning options, I recommend you start small. There are proven techniques that consistently produce profits, and we're going to take a look at those so that you will have a bag of tools to use on your journey to grow your trading portfolios. There are proven methods that make money in the stock market. For the most part, there's risk when we're placing trades. So, in a way, we're placing bets with our own money, hoping that the stock market moves in our direction. However, betting and hope, they're not real good strategies. So let's go through a few of the strategies that have proven to be successful over time, and we'll look at how we can use options to increase our profits. The first thing that we need to do when trading options is to place trades with a high probability of profit. Now, when it comes to stocks and picking the companies that we want to trade, we only want to deal with companies that are proven and well known, that have a high market cap and a lot of trading volume. So companies like Google, Amazon, Coke, as opposed to penny stocks that only a few people trade. That has been proven to be much more successful over time. When trading options, we want to also focus on selling options rather than buying options. The secret to making money with options is to be on the winning side. And that side is no doubt the selling option side. Not the side where you're continually buying options and just hoping that the stock price moves in your direction and continually losing money. Options are basically a zero-sum game. An option can either expire out of the money when the strike price is not reached, or in the money when the strike price is reached. There are buyers and sellers in the market, and the supply and demand is what determines the strike prices. When buying options, we want the strike price to be reached and exceeded to make money. When selling options, we do not want the strike price to be reached. And when looking at out-of-the-money options, it is more likely for an option to expire out of the money because that's where it's starting, as in the strike price is not reached. And therefore, as a seller of the contract, we will be on the winning side of that trade. This is because there's a 50% chance that the stock price will move up or down in the very short term. This is due to market pricing. So it's all based on the numbers and the probabilities and the strike price that you choose. Depending on how far you are out of the money you choose to sell, you can actually choose your win rate. By far, the majority of the out-of-the-money options expire worthless. So we will use this knowledge in our trades so that we will have the highest probability of making money. Let's look at an example right now. We'll go to your Tastytrade account or whichever platform you're using. By the way, Tastytrade is one of the best and most intuitive for trading options. I'll put a link down below. Right now, you can get up to $2,000 when funding an account. We punch in your favorite store to shop at, Walmart, ticker WMT, kinda kidding, in the upper left, and pull up the option chain by clicking on the Trade tab. Now we'll open the chain that is closest to 45 days to expiration. This is the sweet spot where you can collect the most amount of premium and not be too far out where things move too slow and you don't collect much more in premium. Or you're not in the closer weekly options either, where you don't collect enough premium. Now the stock price is at $150. If we think the stock price will move up, we can look to sell a put option. Puts are on the right side. We can look to sell the 145 put. Under the bid, you can see that we collect $2.27 in premium for selling the put. Remember, when we sell, we collect premium, and when we buy, we pay premium. The delta is 0.29, so this means there is about a 71%, so it's 1 minus 0.29, chance that the stock price will not drop and breach this 145 short put strike, and the trade will be a winner. Now, on the other hand, the buyer of the option only has a 29% chance that this 145 strike will be reached. So the buyer is betting it will move down below the 145 strike, and the seller is betting it will stay where it is or move up. Now, as we move down in price to the 140 strike, we see that we collect $134 and have a 1 minus 0.18, 82% chance of winning. Makes sense, right? We take less risk and therefore collect less in premium, but have a higher chance that we will win since we are further out of the money and the stock price has much further to move to end up in the money. The further out you go, you will continue to collect less in premium since there is less chance of being assigned. Here is another view. It's the curve mode on the Tastytrade platform. You can see the current stock price is $150 and we collect $227 for selling the 145 put option. We then have a 73% probability of profit. The break even is the 145 strike minus the $2.27 in premium collected, so it's $142.73. As long as the stock stays above this price, we make money. It would take a 5% move down from the current 150 price in the next 42 days before we would start to lose any money. Now, if we flip it and buy the option, we pay $232 and have just a 27% probability of profit. The stock price would need to move down to that $142.73 price before we even started to make a penny. So do you want to be the option buyer and have a 27% chance of winning, or the seller and have a 73% chance of winning? No brainer, right? You definitely want to be the seller. The next thing that we need to consider is the fact that it has been proven that long-term investing makes more money than short-term trading. Trying to time the market and constantly being in and out of investments is difficult, if not impossible, to do well and make money consistently over time. However, we know being long in the market is a good thing. So you're probably thinking, what are you trading short-term options for, Darren? And you're right. However, I'm doing it with a longer-term perspective in mind, and I'm looking to enhance my longer-term positions. So instead of just buying and holding long stock, we want to use options as a better way or a smarter way to enter and exit positions. So instead of just buying and holding long stock, we want to use options in a smart way to have a better way to enter and exit positions. We do this by selling options. When we sell puts, we are obligated to buy stock when the strike price is reached. Now, in wanting to collect premium, we don't want the short put strike to be reached so that we can collect the premium. However, if we are bullish and want to buy the stock anyway, we can sell that put option. We sell the out-of-the-money put below the current market price. By doing this, we collect that premium. And we also get to keep that premium collected whether we're assigned or not. There you go, some extra free money. The third proven step is reinvesting and compounding to grow your wealth. Most people, after buying a stock, just forget about it and go on with their lives. Sometimes that works. However, companies have management changes and different earnings results over time. There are good companies and bad companies, and sometimes things change. So we don't want to just buy a stock and then go watch a movie. The key to growing your wealth is to actively add to your positions in various ways. Dollar cost averaging is a good way to automatically add to your investment account. So maybe you have a certain amount set to be automatically transferred into your investment trading account every month. This way it's automatic and you just live with it and you don't even have to know it's being transferred. It just appears automatically like magic. We then use that money to buy more positions. Another way is through dividends. If we have stocks that we own that pay a dividend, that's great. We take that quarterly dividend that some companies pay, companies like Coke or Chevron, and we reinvest that back into our trading account. So we're constantly growing our positions, and this will compound over time and create a snowball effect, growing our account much larger and larger and larger. Another strategy that we like to use for monthly income is to sell calls against stocks we own. This is exactly the opposite from selling put options. When we sell a call, we collect a premium for selling the right to sell the underlying stock at the strike price, should that strike price be reached. So what we are doing is we are selling when the stock has moved up significantly enough to reach the out-of-the-money short call strike price. So we are selling at a high once we have already made money by the stock price moving up. We are buying low and selling high. Many traders do the opposite. They buy high and then panic and sell low when there's a dip in the market. I've never done that, have you? Our goal when selling calls is really not to reach the strike price, since we are holding only stocks that we are bullish on, and sometimes we want to continue to hold those stocks. So we're using our portfolio to generate more money through dividends, selling calls, and depositing more money. Let's look at selling a call in Target. We are long and own the stock, so we think the price will go up. So we punch in TGT on the Tastytrade platform in the upper left. Let's pick the June 2023 option chain since it's closest to 45 days to expiration, which is the sweet spot. We pick the 170 strike price. Currently, the stock is trading at 156. So it would take a $14 move up in order to reach that strike price and trigger us to sell our 100 shares. That would be an 8% move up in 42 days, which is pretty big. We switch to the curve mode. Now, our goal is not to exit the position. Instead, it is to collect the premium and retain the 100 shares of stock. So we are saying that by June 16th, Target will not hit the 170 short strike price, and we have a 78% chance of being right. Keep in mind, if you were a buyer of the 170 call, you would only have a 22% chance of being right. Now, we already own the 100 shares of stock. This graph just shows the profit zone in green on the call by itself. So most likely selling the option contract will be the winner and buying it will be the loser. Here's the curve mode graph and profit zone for the overall covered call position. This shows the 100 shares we own and the call that we just sold against 100 shares of stock that we are putting up as collateral. You can see the buying power effect is $7,580. This is the amount of money that we need to place this trade, and it's what our account is utilizing. Since we are collecting $247 in premium, that's about a 3.25% return on our investment in just 42 days. That equates to an annualized return of 28%. That's not too bad for just collecting extra income on stock we already own. So we add that to the increase in value of the stock as well. Eventually, we just take the premium collected and reinvest it, and we grow our empire. To take these concepts and put them into one simple formula, it would look something like this. We sell high probability of profit options in stocks that we want to own, plus we reinvest income, premiums, and dividends, plus we let it compound over time. This equals winning with options in the stock market. Now, to take that formula and break it down in a little more detail, first, we save enough money to buy 100 shares of stock that we're bullish on and think will go up in price. We use this money to sell an out-of-the-money put in the stock that you selected with about a 75% probability of profit, so around the 25 delta strike. The goal is to buy the stock at a cheaper price than the current market price while collecting option premium. If the short strike is not reached, you rinse and repeat and sell another put in the following month and collect more premium. Once you're assigned, we use the cash that we have in our account to buy more shares of the company. Congratulations, you just got a great deal on your favorite company stock. Then we sell a call against the stock at about the 1 standard deviation or 16 delta point. The shares of the stock that we own are used as collateral. Selling the call will allow us to collect a premium and likely retain the stock. Selling the 16 delta call gives us about an 84% probability of profit. If the stock price does breach our short call strike, we can roll up and out to the next monthly option cycle and likely collect more premium. If for some reason our opinion on the stock has changed and we're no longer bullish, we can just let the stock get called away and be done with it. We take the premiums that we collect and then reinvest back in the market using the same strategies. If you collect dividends on any of your stocks, you can take those dividends and reinvest in stocks as well. Our ultimate goal is for our portfolio to generate income for us and use that income to continually grow our portfolio through reinvestment. When we don't want to sell our shares and move on to another stock for whatever reason, we just don't sell our shares. Instead, we sell a call that is closer to at the money, which is the actual current price of the stock. This way, we collect a large premium up front, and if the stock moves up a little, we are out with that premium collected. Now, isn't that much better than just buying and holding stocks like most people do? This strategy works great in a retirement account since you likely don't have to be too concerned about paying short-term capital gains to the taxman. In a non-retirement account or brokerage account, you may want to consider rolling your calls up and out at least a couple of weeks prior to expiration. That is, if they're in the money or close to in the money, to avoid getting called away and having to sell your shares and having to pay those taxes to Uncle Sam, as he obviously knows how to spend the money better than us.
Yeah, right.
One last tip. Right now, most brokerages have up to about $250,000 in FDIC insurance coverage per borrower. What this means is if something happens and the brokerage or bank closes, you are covered up to that amount by the government. So if you have more than that amount, I recommend having multiple accounts at different brokerages. There's a link to Tasty Trade down below if you don't have an account with them set up just yet. Right now you can get up to $2,000 when opening an account.
So check them out. They're a great brokerage. However, I'm just happy if you hit the like button right now. Now, if you haven't seen any of my other videos, please check those out. I put a link down below for the free options workshop. Be sure and grab that. All right, guys, thanks for watching. Really appreciate you taking the time to watch today. Please share the video with a friend. Also, leave a comment down below. Let me know what's working for you, what you're doing in your options trading account. It really helps to get the video out to more people by getting your comments. I need comments, guys. All right, really appreciate it. Have a great day. Happy trading.